Imagine working hard your entire life, saving every penny, investing wisely, only to wake up one day and realize that everything you built is being silently taken away from you. Not through a tax increase, not by theft, but by an invisible system designed to transfer your wealth without you noticing. This is financial repression, and it is one of the most effective tools that governments use to control economies, pay off debts, and keep citizens obedient. Most people have never heard of it, but it has shaped your life since the day you opened your first bank account. Before we begin, let me know in the comments which country you're watching from and what time it is where you are. It's fascinating to see how this story connects us all. And while you're here, if you want to understand how the system really works, not the version they show on TV, make sure to subscribe, because what you're about to learn will change the way you see your savings, your retirement, and your financial freedom. To understand financial repression, you first need to grasp a simple truth about governments. They always spend more than they earn. They borrow to finance wars, social programs, bailouts, and votes. And that debt never truly goes away. It only grows decade after decade. But here's the problem. If a government has too much debt, it faces two choices: default or destroy the debt through inflation. Default means political suicide. Inflation, on the other hand, is silent, stealthy. It looks like nothing more than rising prices, but in reality, it's the slow transfer of your wealth to the state. That's where financial repression comes in. It's a strategy that combines low interest rates, high inflation, and strict capital controls to slowly erode the real value of debt, while trapping savers like you in a system that guarantees losses. Here's how it works. When you deposit money in a savings account, you expect to earn interest. But in a repressed financial system, the government and the central bank work together to keep interest rates artificially low, often below the rate of inflation. That means that if inflation is 4% and your savings earn 2%, you're losing 2% of your purchasing power every year. You're not being paid for your savings. You're being taxed stealthily. And unlike regular taxes, there's no vote, no bill, no announcement. It happens automatically. Each year, the real value of your money decreases. Over time, the government's enormous debts become cheaper to repay. Savers, pensioners, retirees, they bear the cost. It sounds like a conspiracy, but it's not. It's economic policy. After World War II, the United States and the United Kingdom used financial repression to manage massive debt loads. Central banks kept interest rates far below inflation for years. Governments introduced strict regulations that forced pension funds and banks to hold government bonds, ensuring a steady flow of cheap credit. Savers were trapped. Their returns couldn't keep up with inflation, but they had nowhere else to go. In the 1950s, debt to GDP ratios fell rapidly, not because governments paid their bills, but because inflation quietly erased the real value of what they owed. That was the hidden genius of the system. The pain spread slowly, invisibly, across millions of ordinary people. No protests, no panic, just a slow draining of wealth from the private sector to the public one. If you had lived in that time, you wouldn't have noticed. You would have simply seen life getting more expensive and your savings earning less. Now, fast forward to today, global debt has reached levels never seen before. In the United States, it already exceeds $34 trillion. Worldwide, it represents more than 300% of GDP. There is no realistic path to pay that back. So what's the solution? The same one they used before. Repress interest rates, print money, and let inflation do the dirty work. In 2020, when central banks cut rates to zero and flooded markets with liquidity, they didn't just save the system, they rebooted it. For debt-soaked governments, this is the perfect scenario. Inflation runs at 5 or 6%. Wages rise slowly and savers quietly lose. Debt, in real terms, shrinks. You might think, well, I can just invest in assets like stocks or real estate. But that's part of the design. When money loses value, people are pushed into risky assets to protect themselves. That inflates markets and helps governments too. Rising asset prices create a wealth effect. People feel richer, spend more, and the economy keeps turning. But here's the problem. Those who already own the assets benefit the most. The rich get richer, while everyone else runs faster just to stay in the same place. It's not an accident. It's the structure of modern capitalism, built on inflation, debt, and financial repression. You might ask, why not just raise interest rates? Because doing so would break the system. Governments can't afford high interest payments. Every single percentage point increase adds billions in interest payments on public debt. That's why central banks pretend that inflation is transitory, even when it's not. They know the truth. They can't stop it without bankrupting their own governments. So they let it happen. And meanwhile, your savings burn slowly. The cruelest part is how they disguise it. They say inflation is a sign of a growing economy, that low interest rates are good for investment, and that everything is under control. But behind those polished statements lies the real policy. Increase debt, keep savers trapped, and ensure that no one escapes the system. Capital controls make it hard to move your wealth out of the country. Regulations ensure that banks hold government bonds, and financial markets are designed to reward speculation, not saving. It's not chaos, it's control. This isn't new. It's the oldest trick in the book. The difference is that now it's global. From Washington to Tokyo, from London to Berlin, every central bank is doing the same thing. And every saver, investor, and worker is caught in the same invisible web. To understand how deep this strategy runs, we must look at history's largest experiments in financial repression. After World War II, Britain owed more than 250% of its GDP. It couldn't pay that debt through growth or taxes alone, so it turned to inflation. Between 1945 and 1980, average inflation was over 6% per year, while the average yield on government bonds stayed below 3%. That gap, the space between what savers earned and how fast prices rose, silently erased half the national debt in real terms. There was no collective forgiveness, no major defaults, just decades of invisible confiscation. The government pretended to protect savers, but in reality, it fed off them. The policy worked because almost no one understood what was happening. The numbers in bank accounts stayed the same. Only purchasing power disappeared. The United States used exactly the same method. After the war, US debt exceeded 120% of GDP. But instead of austerity, the rulers chose what economists politely call financial repression. By capping interest rates through Federal Reserve regulations, they ensured that inflation rose faster than yields. Between 1946 and 1956, real interest rates were negative in almost every year. When the 1950s ended, US debt had fallen to less than 60% of GDP, not through fiscal discipline, but through silent confiscation. Every saver paid unknowingly for the government's war bills. That is the genius of financial repression. It uses inflation as a weapon, low interest rates as the delivery system, and public trust as camouflage. Governments present themselves as responsible stewards while slowly draining private wealth. And because the process is slow, people don't rebel. They adapt, blame the markets, corporations, or bad luck, but never realize that the system itself is built to extract. The same playbook is running today. Since 2008, central banks have printed more than $30 trillion globally. They call it quantitative easing, but it's simply pure money creation. The new flows of capital reach banks, asset managers, and governments first. By the time the money reaches ordinary people, prices have already gone up. The result is predictable. Asset inflation at the top and cost of living inflation at the bottom. The rich see their portfolios double, while savers earn near zero returns. The middle class takes the hit. Wages lag, rents soar, and retirement savings shrink. And why don't citizens protest? The reason is psychological. Inflation is confusing. Financial repression is not a one-time event like a tax hike or a new fee. It drags on. It's the silent subtraction of value, the erosion of economic memory. You can never point to the exact day your money became worthless. It just happens slowly, disguised, until one day you realize what you've lost. That's why financial repression is so effective. It doesn't look like theft, it looks like bad luck. And that's the brilliance of the system. It depends on compliance. People must keep their savings inside the system for control to work. That's why governments and central banks discourage alternative stores of value. They mock gold as an outdated relic, dismiss Bitcoin as mere speculation, and regulate capital flows to make sure your wealth can't escape. In the 20th century, countries like the United Kingdom and the United States even banned the ownership of gold at certain times. Today, they use regulation and digital surveillance to monitor every transaction. You are free to save, as long as you save in assets they control. And make no mistake, control is the point. Financial repression is not only about managing debt, it's about dependence. When citizens depend on the state for economic stability, they become easier to govern. You work, you save, you pay taxes, and the system quietly takes back what's yours. The government doesn't need to confiscate property or raise taxes directly. It simply manipulates the value of money until the result is the same. Look at Japan as an example. For decades, the Japanese government has kept interest rates near zero. Savers earn almost nothing while inflation targets remain modest. This policy allows Tokyo to sustain debt levels above 250% of GDP, the highest in the developed world. Japanese citizens still believe they are safe, but their purchasing power has been stagnant for a generation. Their savings fund the state, not their own future. And since capital controls and national institutions dominate the market, there's no escape. The same story is unfolding in Europe. The European Central Bank spent almost a decade keeping interest rates below zero. Pension funds struggled. Retirees were forced to take more risks, and governments kept borrowing freely. When inflation surged in the early 2020s, it was already too late. Rates rose, but debts were larger than ever. The system trapped itself. Central banks couldn't normalize policy without triggering a financial crisis, so they accepted inflation as the lesser evil. For the average European, that meant higher prices, weaker pensions, and reduced savings. The silent cost of keeping the system alive. Now imagine that same mechanism operating on a global scale. The United States issues the world's reserve currency, the dollar. That's why its policies echo everywhere. When the Federal Reserve suppresses interest rates, it doesn't just affect Americans. It forces the entire planet into the same trap. Emerging markets see their currencies weaken, capital flees to the dollar, and their external debts become more expensive. The result is a global architecture of repression built not on coercion, but on dependence. Every central bank takes cues from Washington. Every investor follows the dollar's signals, and every saver ends up holding assets that lose value in real terms. Financial repression works best when people believe it's temporary. Politicians and economists always promise that low rates or money printing are short-term measures. They never are. Once a government becomes addicted to cheap debt, it can't stop. Every crisis becomes an excuse for more intervention. Every recession justifies more liquidity. The longer it lasts, the harder it is to unwind. And at every step, your wealth buys a little less. There's a cruel irony in how the system sells itself. They tell you to save. They tell you to invest responsibly. They tell you patience and prudence will pay off. But in a repressed financial order, those virtues are punished. The reckless speculator thrives while the cautious saver bleeds. That's the moral rot at the heart of the system. It rewards those who play the game, not those who create value. It's no wonder trust in money is collapsing. But if you think the system is unstable, you're right. Financial repression can last decades, but it always ends the same way. In crisis, inflation erodes trust. Citizens look for escape, and eventually the state loses control. That's when history turns violent. Every empire that mastered financial repression eventually faced its reckoning. Rome debased its silver coins to fund endless wars. At first, citizens barely noticed. Prices rose slowly, and soldiers were still paid. But over time, trust collapsed. Merchants demanded more coins for the same goods. Soldiers refused devalued pay, and the empire's trade networks crumbled. What began as clever fiscal policy ended in economic ruin. The same cycle repeats in modern times. When you corrupt money, you corrupt everything built on it. Trade, savings, trust, and ultimately civilization itself. Modern governments think they are smarter. They believe they can print, suppress, and manipulate without consequences, because they have spreadsheets and PhDs. But mathematics doesn't change. Every time you force real interest rates below inflation, you plant the seeds of collapse. The only question is how long it takes to grow. In the post-COVID era, we saw the perfect storm. Trillions in stimulus flooded the global economy. Central banks kept rates at zero, and inflation came roaring back. At first, authorities dismissed it as transitory, but when reality set in, the damage was done. Savers lost years of real returns. Housing, food, and energy costs skyrocketed, and the middle class, already fragile, found itself squeezed from every direction. This is the unspoken truth. Inflation is not a bug, it's the plan. When governments borrow too much, they need inflation to reduce the real weight of their debt. They just need it to rise a little faster than interest rates. Not enough to trigger panic, just enough to quietly siphon wealth. It's a balancing act between deceit and disaster, but history shows that balance never lasts. Eventually, inflation slips out of control. People rush toward real assets: land, commodities, gold, Bitcoin, anything the government can't print. And once trust breaks, no decree can restore it. Financial repression thrives on illusion. The illusion of stability, the illusion of control. As long as citizens believe the system is fair, they'll keep playing the game. But when they realize the game is rigged, they start looking for exits. That's when policymakers panic. They impose capital controls, wealth taxes, and digital restrictions. They claim it's to fight crime or protect the system. But the real motive is always the same: to trap capital inside a dying currency. The rise of central bank digital currencies, CBDCs, is the next step in this evolution. With programmable money, authorities can directly apply negative interest rates, restrict how you spend, or even make your savings expire to force consumption. It's the ultimate tool of repression, a financial prison disguised as convenience. Think about it. In the past, if your bank paid almost zero interest, you could withdraw cash and hold it yourself. That physical option created a natural floor below interest rates. But in a world of fully digital money, there's no escape. Every dollar, euro, or yen becomes traceable, taxable, and if necessary, deletable. Governments can drain wealth invisibly and instantly. Combine that with inflation, and you get total control. A system where citizens own nothing real, and every asset is denominated in melting ice. We've been here before. In the 1970s, after decades of repression, the link between the US dollar and gold finally broke. Inflation skyrocketed, interest rates exploded, and the illusion of stability was shattered. It was painful. Recessions and double-digit rates were required to restore trust. But here's the warning. Today's debts are far larger, and today's citizens far more dependent. Returning to honest rates would bankrupt governments, implode markets, and destroy pension systems. So instead, policymakers will likely double down. More stimulus, more printing, more control. They will promise price stability while quietly eroding everything you own. For the average person, this creates a paradox. You're told to save, but savings lose value. You're told to invest, but markets are inflated by policy, not productivity. You're told the system is fair, but it punishes prudence. So what can you do? Awareness is the first defense. Once you recognize financial repression for what it is, a stealth tax on savers, you can adapt. Diversify beyond fiat currency. Hold assets tied to real value, commodities, productive land, businesses with tangible results. These aren't just investments. They're forms of escape. But the deeper issue is moral. What happens to a society when honesty no longer pays? When frugality is punished and speculation is rewarded? That's where we are today. A generation has grown up believing that wealth comes from leverage, not labor. Governments applaud this because bubbles create the illusion of prosperity. But illusions can't last forever. Every suppressed rate is a future crisis postponed. Every dollar printed is trust borrowed from tomorrow. And one day, the bill always comes due. In the end, financial repression is a symptom, not the disease. The disease is political cowardice. the refusal to confront debt with discipline, to tell voters the truth, to live within limits. Printing and repression are shortcuts, and like all shortcuts, they lead to cliffs. The people who suffer most are not the powerful. They are the savers, the pensioners, the workers who played by the rules. Their wealth is silently transferred upward, and when the system breaks, they are told it was unexpected. But there's nothing unexpected about it. It's just mathematics. Zoom out and you'll see the pattern. Every time debt overwhelms an empire, it turns to inflation. Every time inflation corrodes trust, the empire tightens control. And every time control reaches its peak, the people find a way out. A new money, a new system, a new beginning. Rome fell. The British pound lost its crown. And one day, the dollar will face the same fate. The question isn't if, but when. So next time you hear a central banker say that inflation is under control, or that real rates will remain low, understand what they're really saying. They're admitting the plan. Your savings are the collateral. Your future is the funding source. And the longer you stay in their game, the more you lose. But here's the hopeful part. Knowledge is leverage. Once you understand how financial repression works, you can act beyond its reach. You can create value in the real world, in skills, assets, and relationships that no policy can inflate. That's the real rebellion. The system depends on your ignorance. It fears your awareness. Because when people see the cage, they stop mistaking it for safety.